Okay, I would say let's get started. Hey everyone, it's really great to have you all here. We're talking about investor due diligence today, a topic that interests every one of us here. It's a topic that, or something that every founder raising money has to go through. But it's not always clear for us what is actually happening behind the scenes. And that's why it's super cool that we have this panel here today where they can share diverse perspectives on the topic. We'll get into how investors approach it, what founders often miss, and also how the process is evolving. But before we start, I'd like to just briefly introduce myself. My name is Jana. I am a co-founder of Beams, usebeams.com, together with Miri, who's also in this call. Beams is a SaaS tool insights platform. That means that we generate deep tool usage insights. We understand which tools are being used in a company. Are they really being used, or are there underutilized licenses? So companies use it to reduce SaaS costs and also to ensure security and compliance. And an interesting use case that is gaining traction for us is the due diligence process. So we're seeing more and more acquirers, investors, and also founders using our product during due diligence. Because when companies acquire other companies or when investors invest, they usually look at the tool stack, what tools are being used in the company they're acquiring or investing in. And we wanted to have more conversations like this one. It's one that we are looking for ourselves, and we want to, help founders be better prepared. I have prepared a few questions to guide us through this conversation, but feel free to ask your questions as well in the chat, and I'll try to bring them in as I see fit. For your information, we are recording this talk. So I hope this is okay with every one of you. If not, you're welcome to not join. Okay, then let's get started with introducing our speakers. We have two amazing speakers today who have seen due diligence from different angles, both as investor or as founder. And first we have Ashley Smith. She's a solo GP based in New York City. She invests in early stage technical founders with her fund Vermilion Cliffs Ventures. And she's also an investor in Beams, in our startup. And before becoming an investor, she was an early employee at GitHub, GitLab, Parse, and Twilio. And then we also have Jürgen Vogel, who has been through it all, raising money as a founder, exiting his startup, and now also advising VCs on tech due diligence. But before we dive in, I'd like for both of you to quickly introduce yourselves as well. Maybe share a bit about your journey, how you got to where you are now. And let's start with Ashley.
Hey everyone, I'm Ashley, and originally an engineer, operated for a long time in go-to-market, as mentioned early at Twilio, Parse, GitLab, and GitHub. After operating, I went into an institutional investor role as a venture partner where I did a lot more diligence because it was later stage. And then currently my fund, I don't lead, it's pre-seed and seed, so I don't do as much diligence as other investors that are leading and later stage. So most of my diligence perspective is going to be around founder and potential customers or potential market, less so like deep into the technical diligence or that of someone leading around.
All right. And over to you, Jürgen.
Yeah. Hey, y'all. Thank you for having me on this call today. Yeah, my career started in my childhood already. I always wanted to basically live inside my computer and figure out how everything works. So I ended up in software engineering quite early on. Did this for a long time as an individual contributor, working for lots of different startups. Then eventually started my own AI company in 2016, had an exit in 2022. Like the pattern or like that one theme across these years was always that I was very focused on leadership, excited by tech, and into company building. And I thought like these insights were like the best foundation for doing tech due diligence, because I think it always comes down to these different aspects, like how are things run, what's the tech that they are building, and then also like how is the whole company working. And only if you look at all of these things together, you can really assess a company.
Cool. I love how you both already touched upon the topic. So let's get right into it. Ashley, you mentioned it already. With your fund right now, you're investing early. You're not doing the due diligence as such. You're not leading. But maybe you can dive a bit deeper. How do you look at the teams you invest in, at the products and companies you invest in, and how does that differ from someone who would lead and who would do a due diligence?
Yeah, so there is due diligence. It's just different when you're early stage because you may not have a product or even a deck in some cases to look at, which I like. I like very early before there's actually any product. So you're looking at founders, if they've worked together before, if they've been on a team before, if they can actually and not fight their way through the first 2 years, because it's a very stressful thing, you all know, is starting a company. And so that's the first thing I look for. Market is huge, right? Like it's really hard to get product market fit. So trying to understand what the market looks like, even prior to there being even a single line of code, I think is key for me. So like that diligence is happening. It feels like in a bubble with just me in it, but it's really me texting and emailing with friends that have worked in tech for a long time to understand like, hey, would you use this? How would you use it? How would it fit in? And then every once in a while you get a few customers. So like one or two, maybe three like pilot customers using that product. And so I'll just ask if it's okay for me to speak to that person and understand, it's hard as a potential customer to take a chance on a startup that you don't know will be around in 6 months or a year. And so I always try to understand what made that pilot customer decide to take a chance on that particular startup and that particular set of founders. And so my diligence is quick because, I'm not leading, I'm not the large check on the cap table. And so I don't want to waste a founder's time if it's going to be a no, and like most cases it is a no, right? So my diligence is very quick. I try to say as soon as I know it's a no, I tell them immediately. But yeah, I'm not doing Series B deep diligence going through like customer data and all that. Like that just doesn't exist for me. Previously I did, but this is a very different setup, which I really like because you're just kind of diligencing the founder and the idea, which I think is way more fun.
And without going too much in depth, but you mentioned it, the later the stage, probably the more in depth the due diligence as well. How does it change? And do you also advise the founders you invest in like due diligence of the later rounds that they raise?
Yeah, I mean, it definitely changes. A few of my fund is newer, but a few of the companies have raised A's. And a lot of the A's are getting preempted right now, and the diligence happens before really the fund even talks to the company, which is interesting. And so they'll go do a bunch of diligence in the background and then go and try and preempt that A. And so a lot of founders that are getting a Series A right now are actually not running a process, I've noticed. Like that seems to be, I mean, this is very US centric, but they're not really running much of a process. And the reason there would be generally what I've noticed happens within the bigger funds doing later stage, and to me, later stages A's and B's, is someone will say like, "Oh, we're using such and such company to do this," and I'll be like, "Oh, what's that?" Right? And then that partner or associate or VP or whatever at the fund will go and start asking around about that particular company, startup, and founders. And so that's the part of the diligence that I think is pretty interesting, is a lot of it happens before you even realized you're being interviewed. So I think there is like the hint is like assume you're always being interviewed or you're always being diligenced, because you probably are if you're at the point where you're about to hit a Series A or a B and beyond. And so like I get the question, we have a website. Like you should have a website. Like it should reflect what you do. And I think that just say you're not raising money for a year, getting ahead of it by 9 months is probably correct, because people are already looking if your company is, even doing slightly well.
Yeah, true. And interesting points also on the US perspective that you're sharing. I guess Jürgen is more sharing a European perspective.
Yeah.
Mostly, yeah.
Yeah, Jürgen, since you've been advising VCs on tech due diligence, what have you learned about this process that you maybe weren't aware of as a founder before?
Yeah, what I never really reflected as a founder is how much it really matters what the investment hypothesis is. So not every due diligence is equal, and you really need to tailor your conversations and how you talk about your tech stack, your product, your product management, how you do discovery, how you work with customers. You really need to tailor that to the investment hypothesis to make sure that you can support the growth that you are foreseeing or that you are planning, or that you can adopt the company in a specific direction, that your team is set up for team growth, for instance. Like really being aware of what that investment round means and what you're aiming for, I think is super important, and something I never really completely reflected, I think, from a founder perspective, or like companies I was working with beforehand when we went for a technical due diligence. Like we were always a bit surprised that, oh, suddenly it comes up, and we didn't really have anything in place.
And when you say you didn't have anything in place, like what are the things one should have in place?
Yeah. And I think like from my past experience from like 10 years ago, most tech DDs were quite superficial. So there was a technical person coming in for a day, maybe asking some questions, mostly doing interviews, and maybe looking at some slides that the founders were creating on, hey, this is the great platform that we have built, with like an abstract high-level diagram of, hey, this is our platform and this is our AI, and that's how we do great stuff. This is what I found always surprising, that this is often the level on which this is happening. But I also see that this is improving now, and it's getting more into the details. That there are companies around who do like a proper check of the source code and really look into knowledge distribution and how teams are really set up and how they are working. Yeah, what is it you can prepare beforehand? Managing or having an idea or like a basic strategy on how you manage the different risk points that can come up. Like a typical example there is technical debt. Something is around in every company. It's unavoidable. It's a natural part of software development. But when I come into a company and I talk with the CTO about technical debt, and there's no idea of what is it that is around, and there's no backlog, no strategy, no conversation about what is it that we need to tackle in the future, then that's a finding or an issue in such a DD. So yeah, that's it. What you need to have in place: awareness of where you are, where you want to go, and what's the gap that you need to tackle.
And you mentioned tech debt as a recurring theme or a risk you would look out for. Any other like big technical risks that investors would worry about in due diligence?
I've got a new one that I have had to start diligencing. If you build a technical product, or if you're an engineer, you use GitHub, and GitHub stars are something that for a long time people have been tracking to say like, oh, this thing is loved by the community, it's got a lot of open source traction, etc. And you can buy GitHub stars, which is kind of a nightmare, right? That you would want to go buy GitHub stars. It's the same as buying like Instagram likes or the like. So I was diligencing a company a few months ago, and I noticed that the GitHub star chart was just like off. And as someone who's been a GitHub user for a long time, I'm like, that's an inflection point that doesn't quite make sense. And realized that there's a whole GitHub star buying ring. And there's if you search for there's a script that you can run to kind of figure out what of the GitHub stars are real. And yeah, so that's just something to be aware of is like don't buy GitHub stars, first of all, because a lot of the technical investors are starting to check that. And I've been checking it on any open source company that I'm looking at. I've started just like part of my process in the background. So I think that's one big one that may be happening more of. And I'm sure GitHub will figure out a way to make it so you can't buy GitHub stars soon, but it's a real thing.
Interesting. Maybe also as a question to the participants here, feel free to share in the chat if this is something you've experienced as well, if you track your tech debt, if you look at the GitHub stars as well, and if you share that experience, feel free to share in the chat as well. Follow-up question to Jürgen. When it comes to due diligence in the process, do you also look at the tool stack? And that's, of course, the little loop to our product. And what does that look like? Like, why is it important which tools the company is using?
Yeah, this is typically part of a proper tech DD to also look at like IT and like all the supporting functions that at the end of the day feed into tech. And tools, SaaS tools that the company is using is an important part of that. Um, one lens through which you can look for that is like data security, data privacy. You want to make sure that the company has like processes in place and an understanding of what data is shared with which vendor. You also want to make sure that like accounts are properly secure, that you have single sign-on rolled out for all of these accounts. And I think it also gives some insights into ways of working with a company. If you have like it's not untypical to see a company with 100 employees and they have like 50 different SaaS tools. I've even seen worse than that. But if you see that a company with 100 people uses like 3 or 4 different tools for project management, that gives you some insights into the company culture and maybe a good hint, and maybe that leads you to a bigger finding if you see some other things as well.
Cool. That's really good to hear. And the 50 tools per company that you mentioned, we usually see much higher ones. It's the first aha moment when they see the actual number of tools they're using.
Yeah. The last company I had a look at has had about 100 tools on 200 employees. Yeah.
Wow. Yeah. Yeah.
Gosh.
It's probably average of what we see as well. Okay, when it comes to red flags or maybe things that founders would underestimate about due diligence, what comes to your mind immediately? Or maybe one thing that every founder here in this call that they can take with them today, what's really something that founders usually underestimate? Ashley, would you like to start?
Yeah, for me, it's pretty simple, and it happens all the time, is when 2 or 3 founders are on a call and they start disagreeing with each other and in a moment when they're supposed to look kind of together. I think that's always hard to come back from. I've had people fight on the pitch call before about like a question I'll ask and don't not agree with the answer. And I'm like, but like this is, like not agree with it, but have that conversation offline probably because it just shows like a misalignment, kind of similar to for product management tools within a company if you can't kind of get aligned on basic questions from a VC.
Interesting point. Yeah, show that you're actually a team.
Yes, yes.
Yeah.
There's going to be disagreements always, but I think that there's a productive way to have them, and having it on a intro call with a potential investor is probably not the best place.
Agree. Jürgen, any?
Yeah, from technical perspective, like the first one that comes to my mind is knowing all the licenses that you're using on your open source libraries that they are so easy to load into your software. And this is something my impression is that like nobody is really paying attention to that. It's not really a problem as you build a product. But it is a big risk for investors. Like one story here, a company I've been working with, they used as like a basic library for basically their internal API services, a library that had a change on their license, and it switched to a paid model, depending on the revenue of the company. And changing that library across their microsystems would have been like a lot of work. So you need to understand, okay, now with that license change, what does this mean? What's the financial impact, either in terms of time invested in changing that library or paying the new fees. So that's a biggie. Then outside of that, it really depends on the stage of the company. I think with like early stage, what I've seen the most is that the CTO slash founder is just overworked, doing too many things at the same time, doing product management, discovery, being an individual contributor, working all day, but then also managing a team, managing the round and so on and so forth. That can become a red flag if that person, isn't really aware of it, and not if the assessment is that the person can't handle to distribute work, or if there's no plan in place to actually hire the right people to support the person in that role. Yeah.
That's an interesting one. Totally agree. I'd like to bring up a question from the audience here from the chat, because Jürgen, you already just mentioned like different stages. What about different types of companies or products? Like the question was for deep tech hardware startups. Any specific recommendations here?
On how to prepare or
on examples or recommendations, I guess, on how to prepare, on maybe also how the due diligence differs.
yeah. So on deep tech in general, this is of course a topic where a proper tech DD becomes more and more important, because it's very difficult for investors to understand claims of how AI is used or how machine learning is done. And it's always easy to create some slides, but it's not so easy to then really bring someone in and to talk that person through everything and to really disclose what is being done. And I think this is an important point to be open for that, to really share with an advisor that comes in on how you're doing things. I think that's super important to establish trust and to not make this a secret.
Yeah, good one. Another question from the audience, and I guess this is happening more and more these days. For startups that have not raised in the past 2 to 3 years, does that bring a concern? Probably not so much tech due diligence, but more commercial due diligence. Ashley, maybe you have a thought here.
Yeah. I mean, the answer is yes. Like it's a hard market. It was an easier market to fundraise in 2 or 3 years ago, and we're seeing a lot of those companies did not get traction and cannot raise another round. And I think a lot of those are winding down right now, or in the process of an acqui-hire or something similar. And so, I don't think fundraising is ever, a mark of success by any means. However, if your goal is to be a venture-backed company and you haven't raised in 2 to 3 years, generally the reasons will be product traction, the market moved and you didn't keep up, or something similar. And so, yeah, I would say it's tricky if you haven't raised another round. I'm talking about early stage. Like there's a few companies that raised giant Series A's or B's and like are just, still spending that money, which is fine, but they would have had to be able to like guess what was going to happen with the economy to say they did that on purpose. And so if something earlier stage, like a pre-seed or a seed, hasn't, advanced to the next round within that time frame, generally, yeah, it's not a great sign.
Yeah. Can definitely confirm also what you see in the market, but yeah, probably looking for ways how it can still fit into a story you're telling, and making it sound like a story that sounds like it makes sense. We have one follow-up question to Jürgen. You mentioned hiring strategies. So how are hiring strategies evaluated?
So one part of that is what type of technology you're using and how easy it is to find talent. Depending on the geography, if you are hiring on-site or remote first, I think this is a big important factor. to understand, okay, are you hiring in a field where it's easy to get the right people, or is it like something super specific that's gonna put the whole hiring at risk? And then, of course, looking at inside the company of where you are right now, what's the onboarding process gonna be? And then looking at tech, do you have a tech platform that actually allows for for easy onboarding? Do you have code quality that is like easy to understand? Do you have a good developer experience, good local environments, and so on to actually, help these new colleagues to get productive quickly? And then depending on how many people you want to hire, of course, how is your tech structured in a technical way? So that you can actually spin out several teams so that they can work on the same platform together without I don't know, causing conflicts all the time, right? So yeah, different levels there. Having the right talent pool available, being prepared for onboarding, and having a tech platform that actually allows for several teams.
Yeah, I guess it's one of these green flags, right? If you can also manage to attract top talent and high caliber talent, something that investors like to see.
Yeah. And then again, coming back to my initial point, if like your tech is not ready yet for further scaling, then this is something you need to know, you need to be aware of, and you need to address that. And you need to say, hey, this is something we are aware of. This is what we want to do to tackle that, to unlock the hiring.
We have 2 minutes left, so I'll ask one last question from the audience, and I'll pick one that is probably very hands-on. So someone said, I bootstrapped a startup with a product that just went live and has great traction. We'll be looking for a seed round in the next weeks. What should I have ready up front before reaching out, apart from a pitch deck? We always hear, you reach out with a pitch deck. Is there any other documents that you should have ready for investors for the due diligence?
Yeah, warm intros are always the best. It's very hard to do cold outreach if you're raising a seed. And so I would say networking and meeting people that can at least introduce you to early stage investors would be really, really great. And yeah, a good pitch deck is important. Not too much information in it because all investors are quickly going to look at it and figure out reasons like to disqualify this company. So you want a very succinct pitch deck and warm intros. And even like a really strong paragraph explaining what you do is almost more important than the deck before you go into that first meeting.
Anything to add, Jürgen?
Depending on how early stage that company is with that round, of course, it's important to talk about prior experience of the founders. Also, like to give confidence on the tech side that you have someone on board who really knows or who did this before. I think this is a big plus point that, especially for early stage companies, makes a difference. And then if there's a proper tech DD on what they have already built, I think if it's early stage seed round, my best advice is to be open and transparent about all the things that are not yet perfect. And in best case, to have this written down somewhere of, hey, these are future things we want to tackle, but there was no time yet. I think this is the best way how to start that conversation.
Cool. That also touches upon a question on transparency that we had. We couldn't go through all the questions. We might share the follow-on ones with you, Ashley and Jürgen, in an email also, and then make a blog post out of that, just to ensure that all the questions here got answered. Half an hour goes by really fast, but we think it's a good format to keep it quick and concise, and it's something everyone can fit into their calendars. To both of you, Ashley and Jürgen, thank you so much for your time. Really insightful, some great hands-on advice, and I think it was a really good conversation and a great panel.
Thank you,
so
Jana and Miri.
much for your time.
Thank you all. Have a good day.
Bye, everyone.